I hope you're having a wonderful day. Welcome to the stock market class. We're going to be talking about how to invest in the stock market under any market condition and what are the basics that you need to know to just get started investing, to get your money moving. Right now cash is trash. If you have money sitting in a savings account, you are losing money. I saw a study the other day. It showed the value of $100 from 1940 to 2021. In 1940, the $100 was worth $100. Today, that same $100 is worth $4.32. So the money that you have in your savings account that's just sitting there is going down in value. It's buying less and less and less. So it's critical that you have your money invested in different assets like the stock market. So we're going to talk about the stock market here today and just give you a really good idea of what you can do to get started. So in the chat box, let us know how you're doing and also let us know where you're listening in from. So there is a live chat right there. You should be able to see it at the bottom right. So just let us know where you're listening in from, how you're doing. And we're going to get started very shortly here. Welcome, John. Welcome, Brandon. Welcome, Janelle. Looking forward to having you. Welcome, Jason. Welcome, Josh. Welcome, Jacob, Carla, Theron. Welcome, Kyra. Welcome, Gady, Fee, Nikki, James, Kyla. Good to see you. Jackie, Nasima, Alex, Claudia, Dawson. Wow, we got everyone from right around the country, which is awesome. Welcome, Adrian. Let's get started here. Let's talk about the stock market. Quick question for all of you. Do you have investments in the stock market? Yes or no in the chat box. Let me know. Are you currently investing in the stock market? Welcome, Chris. Good to see you, Chris Jackson. Kim. No. Yes. Okay, so we got a good mix between yes and no. No. So hopefully by the end of this class, you're going to start investing. So let's get right into it. Now, what we've done is, there's so many different principles and ideas and techniques to invest in the stock market. Quite frankly, it could be overwhelming. There's a lot of different things that you need to do. What we did is we kind of studied all the different systems and ideas and strategies out there. We've made them Canadian and we created it into a simple step-by-step process. This is one of those classes that you may need to watch a few times, but our goal here is in an hour to give you an overview of the most important things that you need to do to invest in the stock market. I'm not going to go too deep into each section, but again, this is going to give you a good framework that you can go from. So here we go. So what are the principles to make money with stocks? 5 important steps with 3 surrounding pillars. Number 1, picking the right accounts. Where you invest is almost as important as what you invest in. I'm talking about the different accounts that you're investing in. Number 2, your asset allocation. How is your money divided is the most important thing. If you're taking notes right now, write down asset allocation, circle it, underline it, highlight it. If there's one thing you could take away from this class is understanding how critical asset allocation is. And we're going to dive deep into that a little later on. Next, index funds and ETFs. This is where it starts to get fun. I'm actually going to give you a live example of an ETF and how to study them. Rebalancing. You can do everything right, but if you're not rebalancing, that could throw your entire portfolio off. And then finally, dollar cost averaging, which is a great strategy for those that are nervous about if the market is going to crash. What can you do to protect yourself if the market crashes? And then finally, we're going to talk about how to automate your investing, how to recession-proof your investing, and how to control your emotions and your discipline. So let's dive right into it. Number 1, picking the right accounts. So there's 2 types of accounts that you have access to in Canada. You have your registered accounts and your non-registered accounts. So I'm going to kind of quiz you all. What type of registered accounts do Canadians have access to? Let me know in the chat box. What type of registered accounts do Canadians have access to? Let's see if anyone can get this. Oops. Awesome, Kyla. So Kyla says your TFSA, your RSP, your RESP. You got it, Kyla. In some cases, some of you might have a lira, some of you might have those things, but for most Canadians, you got it as well, Jane. You have three. I want you to write these down. Don't forget about them. I'm not going to go into too much detail, but these are the accounts that you need to invest in. And the best way to think of them is these are like a shield. When you buy a stock, you need to buy a stock in a specific type of account. That type of account that you buy the stock in is going to protect you from taxes. So, for example, a TFSA, the reason it's so great is you can invest in the stock inside of a TFSA, tax-free savings account, and as that money grows, you don't pay any tax on that money. So if I put $100 and I bought Apple stock, and that $100 turns into $10,000, I can sell that $10,000 and every single dollar goes into my pockets. That's all my money. Woo, that's great. But if you're investing in a non-registered account, you put in $100 and it turns to $10,000 and you sell, you are subject to pay capital gains tax and possibly dividend tax and all these different types of taxes. So really simply, max out your registered accounts first and then move to your non-registered accounts. I have non-registered accounts as well because my registered accounts are all maxed out. All right, let's go to step number 2, which is your asset allocation. Your asset allocation is basically how your investments are divided, how they're organized. So everyone here has a different asset allocation, and your asset allocation is going to change based on your age and your risk tolerance. So as an example, my asset allocation is very aggressive. I have a lot of my money in stocks, very little in safe investments. So I'll give you an example of what your asset allocation can look like. And Tony Robbins, he's got a great quote. He says, the difference between success and failure is not which stock you buy or which piece of real estate you buy. It's your asset allocation. And Tony Robbins interviewed 50 of the world's top investors, and this is one of his biggest insights. So here's an example. You can have your money and it could be divided like this: 40% in real estate, 30% in Canadian stocks, 10% in alternative investments like Bitcoin or cryptocurrency, 30% in bonds. So you could see your money is divided into different types of asset classes. So one of the first activities you should do is you should take a look at all the money that you have invested and create like a nice Excel sheet. You can even just use a journal and figure out what percentages are in what type of asset classes. How much of your money do you have in real estate versus bonds versus Canadian stocks? And this is going to give you a lot of insight on where your money is, because a lot of us, we don't know. And I'll tell you right now, most Canadians have most of their money in real estate. That's where a lot of their money is, and very little in stocks, alternatives, or different types of asset classes. Now, a lot of people ask us, what is the optimal asset class? What is the best asset allocation that you can find? What's the best way? The challenge is one size doesn't fit all. It really depends on your situation, and where you're at. So I want to give you a couple examples. Here's a conservative asset allocation. Maybe you're someone that doesn't take a lot of risk. You're a little bit older, getting close to retirement, and you're like, you know what, man, I just don't want to take a lot of risk. I'm scared of losing money. So I need to have a conservative asset allocation. So here's what you're going to do. You're going to put 70% of your money in bonds. Bonds are very secure. It's almost like you're loaning a company or a government money, and by law, there's an agreement that they have to pay you back. So they're very secure. What does that mean? That means that it's very rare that your money is going to go down and your investments are going to lose value. It's possible, but you're also not going to see your money go through the roof. Like, you're not going to have an incredible rate of return where your money doubles. It's going to be very slow growth, 3 to 5% return. 10% of your money in USA stocks. These are American stocks. 20% of your money in global stocks. This includes Canada, China, India, companies around the world. If you were to do this over the past 20 years, you would have had a 4.6% return. Now, the worst year, you would have lost 8%. That was 2008. Okay, you would have lost 8% only if you sold, right? If you sold, you would have lost 8%, but if you held on, you would have averaged a 4.6% return, which takes into account the worst year of 8%. So here's a more balanced asset allocation. 7.4% average return over the past 20 years. The worst year, you would have lost 20% if you sold. Remember, if you held on, you would have still averaged a 7.5% return, which takes into account the worst year of losing 20%. And aggressive. This is someone that maybe you are more risk tolerant. You could take on a lot more risk. You're a little bit younger. You're going to put less of your money in bonds, more of your money in US stocks, global stocks. You would have averaged about an 11% return and would have lost 31% if you sold in 2008. Now, one of the keys to investing is taking away the emotion and being logical, because you take a look at what happened in 2020, the pandemic. I personally saw my portfolio go down 40% in value. How crazy is that? So if I had $100,000, 1 month, the next month I'm at $60,000. And it took a lot of discipline, a lot of logic to not just not sell, but for those of you that have been a part of Enriched Academy for a few years, we made a video and we did a lot of webinars. We were urging you to continue to buy, continue to dollar cost average. And that's something I did. And what was great was 2020 was my best stock market return. I had a 74% return in the markets. And it was not because I was emotional, it was 100% logic. So again, if you're having trouble, Jackie says, I find asset allocation difficult. Any tips? Jackie, just get something going. Just get something started. That should definitely help out. It's better to get started than to be perfect. And you can use one of these. I'm also going to show you some great asset allocation ETFs. So that will make your life a lot easier. So if you take a look at this, if you have $500 a month and you're invested for 30 years, if you had that money sitting in a savings account, you would have $168,000. If you put it in a conservative portfolio, that same $500 a month, you would have almost 400 grand. At 7.4%, you would have 664,000. And an aggressive portfolio, you had $1.3 million. It's pretty amazing because you can have the same person at the same job, same income level. It could be your neighbor. You're both saving $500 a month. One ends up with $168,000. The other person ends up with $1.3 million. How? Your asset allocation and your investments. So, I mentioned at the beginning of today's class that cash is trash. Ray Dalio is one of the most successful investors of all time, and he said this. He said, do not hold on to cash because there is so much money printing. Inflation is at an all-time high that your money is buying less and less every single month. So you need to have that money growing so that at least it's keeping up with inflation, or else you're gonna really run out of cash fast and the cost of living is gonna catch up to you. So you need to have your money growing. You don't want money sitting in a savings account. That is a major mistake that most Canadians make. So what are some advantages of asset allocation? Number one, decreases your risk. Instead of having all your money in Bitcoin or real estate, you want to have your money in different asset classes. So even if one is not performing, other asset classes are performing, holding you up. Number two, it increases your upside return. So I'm not sure why the formatting looks like that, but it's 100% customized to you. It could change and it keeps you disciplined, right? For me, I started researching Bitcoin and cryptocurrency and I got really excited. And if it wasn't for having an asset allocation, I could have quickly had 40% of my money invested in Bitcoin or Ethereum or cryptocurrency. And that could have really put myself and my family in a very dangerous position if something happens. And then next, it's free. You don't have to pay no one to figure out your asset allocation. You don't have to pay a financial advisor. You can figure this out for free. And there's so many great online resources and tools that can help you determine your asset allocation. Here's one if you're having trouble to start with. You can start with the simple couch potato asset allocation. So you could put 25% in stocks, 25% US stocks, 25% international, 25% bonds. So this is a great way to get started because you're covering all the bases. You're covering all the different sectors. Now, Jackie asked a great question. Really great question. I'm going to see if I can find it. Does your asset allocation incorporate physical real estate or should this just include REITs? Jackie, so ideally, you would have your real estate in your asset allocation. So for example, let's say you have a 50-50 allocation between real estate and stocks. So 50% in real estate, 50% in stocks. Now inside of the stocks, or you can even call it non-physical assets. Real estate is a physical asset, then you can have non-physical assets. And then inside that pool, that 50%, you can have something like this, 25, 25, 25, 25. Another way is you can just have, something like a REIT, right? That you can invest instead of owning physical real estate. You don't have to buy physical real estate to include real estate in your portfolio. So here's an example of an asset allocation. Maybe you do 20% each one, and then you add real estate. So you have 20% Canadian stocks, 20% US stocks, 20% international, 20% bonds, and then 20% real estate. So totally up to you. Again, it's very customized, which is what makes it tricky. Everyone's situation is so different. Everyone's risk tolerance is different. You really just got to take the time, do your research, figure out an asset allocation, and remember, you can change it. So you don't have to be married to it. It's better to get started than to try and be perfect. Hopefully that helps. Great questions coming in. We're going to do a full Q&A at the end. So the most important question to ask yourself is, what is my asset allocation going to be? It's going to keep you disciplined, it's going to keep you sane, and it's going to help you get great returns and minimize your risk. Okay, let's talk about step number 3, index funds and ETFs. So when I'm saying invest in real estate or invest in US stocks or Canadian stocks, what does that mean? It means owning these stocks through something called an ETF, which is called an exchange traded fund. Right? Now, how the heck do these things work? I'm going to give you an overview of the different types of investing. There's really two. There's active investing and there's passive investing. What is active investing? It's buying individual stocks. It's looking at the stock market and handpicking the ones that you think are going to go up in value over the long term. Maybe you're thinking, Facebook, they're in the news a lot. I'm not going to pick them. Tesla, they're the future. I'm going to put more of my money in Tesla, in Apple, in Microsoft. And you're handpicking the stocks that you think are going to do well. And that's really what a mutual fund is. If any of you are invested in a mutual fund, all you've done is you've given your money to a mutual fund manager. And you've given them the permission to buy and sell stocks on your behalf based on their experience, based on their knowledge level. That's really all a mutual fund is. An index ETF is very different. Instead of trying to pick and choose what stocks are going to go up, you're going to invest in the overall market. And however the market does, that's how your money does. Now, quick question for you. Over the long term, what do you think performs better, active investing or passive investing? Put your answer in the comment section. What do you think does better, active or passive? Okay, we have passive. Great job, Mirhet, Brenda, Gady, James. Thanks for putting in your answers. John, Adrian, Zia, Ronnie, Simon, Brenda, Marilyn, Anastasia, Saman. Great job, Stella. So I would say, you know, it's about 50-50, maybe 60-40 for passive. If you're an Enriched Academy student, you know we're a big fan of passive investing. So let's take a look at some of the stats here. So again, as I mentioned, active investing, the description is handpicking stocks that outperform the index. Passive is investing in funds that mirror an index. And an index is just a collection of stocks that follow a certain index, like Canada or India or technology or Bitcoin. There's indexes for that too. So here's an example of an index. It's a S&P 500, which is 500 of America's largest and most successful companies. This is an index that gets filtered every single year. So just because you make the list, like Nike, you can quickly get thrown off the list if you don't maintain a certain amount of revenue and market cap or like value of the company. So you could see from 2010 to 2020, the average return has been about 14% every single year over those 10 years. That's how much the S&P 500 has returned. And you have great companies, Amazon on this list, Apple, Bank of America, Berkshire Hathaway, Campbell Soup, Coca-Cola, Costco, Facebook, eBay, Ford Motors, Harley Davidson. Like these are very well-known brands. Now, when you take a look at it, right now in Canada, there's 17,706 actively managed mutual funds, about $1.5 trillion in assets under management. As Canadians, our money is invested in these mutual funds. Look at this. Isn't this crazy? Only 8% of all mutual fund managers actually beat the market over a recent 15-year period. 8% actually outperform the market over a 15-year period. That means 92% of these actively managed funds fail to beat the market. These include hedge funds. These include mutual funds. It's really difficult to pick and choose stocks that outperform the market. I don't know why. It just is. It is next to impossible, and the odds are against you if you try. You're way better off owning an index like the S&P 500. Because think about it, when you buy something like the S&P 500, you have 500 of the largest and most successful companies that are all great CEOs, great marketing teams, great new hires. They're hiring people from Harvard and Yale. These are like the smartest people, millions of employees working for you, right? It's pretty amazing. And mutual funds are trying to outperform the markets. It's just difficult. If you take a look at the game of blackjack, if you're sitting on a 19, I don't think any of you would hit. Would you hit on a 19? Probably not. You're like, heck no. Your chances of owning a mutual fund that outperforms the market are the same as getting 21 as when you're on a 19. It's that rare. So every time you give your money to a financial advisor, you're hitting on a 19. Every time you try and pick stocks, you're hitting on a 19. I'm not saying it's impossible. It's just extremely difficult. And people that are experts, mutual fund managers that go to school, they have insider information and unique insights. Even they can't outperform the market. It's nuts. If you take a look at it from 2010 to 2020, the average S&P 500 return in Canada was 13.7%. Mutual funds didn't lose money, but they only made 5.9% return, 5.19%. So you're almost tripling your money by investing in something like the S&P 500. Warren Buffett had this really great bet in 2008. He made a public service announcement and basically said, listen up, everyone. If anyone can outperform the market over the next 10 years, I'll give you $1 million cash. So anyone want to take that bet if you could beat the S&P 500? So this hedge fund, a very prominent hedge fund called Protege Partners, stepped up and said, "Oh, we can do it. No problem. This is so easy. We could beat the S&P 500." So this is what happened. It was from 2008 to 2018. The S&P 500 had a total return of 86%, about 8% per year over the 2010 to 2020. What rate of return, total return, do you think Protege Partners got? So let me see your guesses in the comment section. The S&P 500 got an 86% return. What return do you think Protege Partners, the hedge fund, got in that same 10-year period? Okay, Paul said 26%, 50%, 35%, 40%, 50, 45. Great job, everyone, for doing the activity and engaging. Really appreciate that. So here we go. Let's check it out. 21%. Isn't that crazy? You would have been better off putting your money in a savings account than investing in this hedge fund. And guys, this is a very prominent hedge fund. You need I think $75 million to invest with them. It's got some of the most successful investors managing it, and they weren't even close. Not even close. David Swinson, he is one of the most well-known investors of all time. He said on an after-fee, after-tax basis, over a reasonably long period of time, there's almost no chance you end up beating the index fund. Warren Buffett, one of the most successful active investors of all time, said it himself. It's so simple. Indexing is a way to go. Invest in great businesses without paying all the fees of a mutual fund manager. Hang on to those companies. You will win over the long term. Isn't it funny, Warren Buffett, that he made his billions of dollars by being an active investor, is telling the everyday person to be a passive investor. He understands how hard it is, how difficult it is, and he has some insights and some advantages that we don't. Warren Buffett is able to take majority positions in companies like Coca-Cola and make decisions on behalf of that company, like management and leadership. I can't do that. If I invest in Apple, I can't call up Tim Cook and say, "Hey, Tim, I really think that you should reinvent the AirPods. I don't really like how they do this." He's not answering my call. I can't make decisions like that. So, it's better to invest in an index fund and listen to what these guys are saying. So what does an index fund do? Mirror and match the performance of an index. That's all it does. It's that simple. So I wanted to put this to the test. So the green line represents the S&P 500 index. The red line shows you the ETF that represents the S&P 500. So let's see how well the ETF does to keeping on track with the index. Here we go. And you can see it's almost identical. Very, very similar, right? So I'm going to give you a list of different ETFs here in Canada. I actually want to show you how to do your research. So if you search VFB ETF, again, this is the ETF that tracks the S&P 500. Look, $100. For $100, the same amount for shoes, you can buy a share of an ETF and own a piece of 500 of America's largest companies. How incredible is that? How Does that not excite you guys? Let me know. Put in excited if you're excited and like you're just as excited as I am. I don't have words right now. It's just so cool that you can have a little bit of money, invest in things like these ETFs, and get exposure to hundreds of different companies. Pretty amazing. You look at the 5-year return, just on fire. I want to be clear, we're not like ETF salespeople. I sound like an ETF representative. I'm not at all. I don't make any money if you buy this thing. There's no fees, even if I do. But it's just pretty amazing to see what you can do. And you definitely want to do your research on them. I like using a company called Morningstar, and this will just give you more insight onto the ETF. So you can see things like what can you see here? Ba-ba-ba. Okay, you can see the open price. You can see the 12-month yield. You can look at the MER, which is the fee. Look at the fee, guys, 0.08%. Are you kidding me right now? 0.08%. Do you know what the math on that is? So if you have $1,000 to invest, let's see how much you're paying in fees. Oh, whoops, no, it's not that. 8%. You're paying how much? That's 80 cents. 80 cents you're paying for every $1,000 you invest. Now, when you look at the average mutual fund in Canada, oops, 2.5%, you're investing $25. So look at the difference between 80 cents and $25. And then you wonder why these ETFs outperform mutual funds. Well, it's because of the fee is so low. Now, why? How is it that they can have such a low fee? Like, how is that even possible? You know why? They don't have mutual fund managers. There's no one managing your money. You're just investing in the markets. Whatever the top 500 companies are, that's where you're investing. With the mutual fund, you have to pay an individual that's going to buy and sell stocks based on their research and their insight. So, what else can we do here? Let's look at the fund analysis. You could take a look at these. I honestly don't even look at these. I look at the performance for sure. You want to look at the performance and just take a look at the growth. Look at this, guys. This year, you had a 20% return. Oh my gosh, 20% for putting your money in something like this. So if you had $1,000, you would have made $200 this year. If you had 100,000, you would have made $20,000. In 2020, in the pandemic, 15% return. 2019, a 25% return. They're not always great years. Look at 2018, 3%. But whoa, 2013, 40%. Wow. Right? Like, it is pretty unbelievable. You can look at the 5-year return here. I also like to look at the portfolio as well. You could click portfolio. Shields, it's called the morningstar.com. I'll put it in the chat box here. I like to look at this because this will give you an idea of where that money is. So it should be all in US equity, which it is, 99%. There's some in international. You could see the style, the value, size, liquidity. You can see the different sectors they're invested in. So it's mostly technology, which is a great place to have your money in right now. It's just hot right now, technology. And frankly, the top companies right now are technology companies. You can look at the environmental breakdowns, historical sustainability score percentage, their carbon metrics. Pretty amazing to see all those eco-friendly metrics here. Nice to see. And then what you can even do is you can look at the holdings of the company. So let me see where I can see that. So I'm not sure why this one isn't showing the holdings of it, but usually you can actually see the different companies that are in there, which is really just 500 of the largest American companies. Um, I'll show you another one because I did this one yesterday and I saw it. Well, it's very strange. Okay, let's look at VCN. This one is like this one is like an ETF for Canada, right? Because a lot of you are thinking, okay, Arian, this is great for the US. What about Canada? Actually, yeah, Isabel just wrote that, asked that. Guys, Canada is a great place to invest your money. The reality is Canada is just such a small market on the world stage. We're this big, we're really really small. So you should definitely invest in Canada. There's also tax advantages to investing in Canada, but the US, you need to have the majority of your money in the US because those companies, these are the big companies, guys. These are that's the world stage that you're playing on. But again, I have Canada too. It's just a smaller percentage of my portfolio. Okay, so like, look, this is Canada. It's called VCN. Let's take a look at the performance again. Thanks, Sylvia. That's nice of you. Oh, guys, Canada is on fire this year. 25% return. Not as hot as the US last year, 4.6. Had actually a really bad year in 2018, down 9%. It's not horrible because it bounced right back in 2019. But you could see like the 5 year returns 10% each year for 5 years. Not bad. It's not bad. Again, the reality is we're not the same economy as America. We have 35 million people. The US has 350 million people. And yeah, it's different. But Canada's a great country, man. In terms of places to live, I wouldn't want to live anywhere else but Canada. In terms of investing, you got to be logical, right? You got to be logical. Let's take a look at the portfolio. Where is the information here? Okay, guys, look at the holding. Shopify. That is where most of your money is going to be. 7% of this fund is in Shopify. Royal Bank of Canada, 6.5%. TD, 5.5%. Enbridge, Bank of Nova Scotia. Great companies. Shopify is just absolutely on fire these days. My gosh. Um, I'm going way off script here. But yeah, Shopify, what, like $92? It's at 1700. What a cool company that right there. So yeah, hopefully that gives you some insight. Let me get back to the presentation, get back on track here. So there's a great list of ETFs. If you want a great list, go on to Google, just like I did here. Just search top ETFs in Canada. My favorite list is this one by Money Sense. Canadian. Yep. Yeah, you guys are asking, will you have access to this after? Yes, guys, it's on YouTube. You could watch it. You could see the chat room after. So absolutely. But yeah, Jeff's point. Hey, Jeff, take screenshots. Why not? Absolutely. So there we go. Now, how do you trade these things, right? So if you want to buy these things, you got to use a brokerage account. Questrade, Qtrade, Scotia iTrade, BMO. These are some of the top ones in Canada. This is what Questrade looks like. This is what I use. It's easy. You pick the account you want to invest in. I want to invest in my TFSA. You type in what ETF or stock you want to buy. You click buy. What's the quantity you want to buy? Like here, it says, okay, I want to buy 100. Whoa. I want to buy 100. Okay, great. You want to buy 100? This is what it looks like zoomed in. In this case, I want to buy one. Bid and ask. So what does that mean? The ask is how much, if you want to buy it, that's how much you're going to have to buy it for. The bid, if you want to sell, that's how much you're going to have to sell it for. Quantity, how many do you want to buy? Order type, you want to keep it market. You can also do a limit. What does that mean? That means you could tell the software, hey, listen, I want to buy this ETF, but I don't want to pay more than $72.42 for it. So it's going to fix that price for you. Now, if the markets go up, then you might not be able to buy the ETF because, no one is selling it for $72.42 because it went up so much. People are now selling it for $73. So you might have to adjust your order, which you can do. Duration, the account, you click buy. It'll give you an order summary. So in this account, this is my margin account, how much it's going to be, the commission, change in buying power, new buying power, send order, done deal, that easy, right? Okay, next step is rebalance. You want to make sure you're rebalancing every single year to go back to your original asset allocation. Because what's going to happen throughout the year is your asset mix is going to change. Let's say you put 50% of your money in stocks and 50% in bonds, and stocks has a really good year, and all of a sudden your stocks are now 80% of your portfolio, and bonds are only 20%. The reason that's so dangerous is because now 80% of your money is at risk with stocks when your original asset allocation, you only intended it to be a 50% risk. But because the markets change, you have to just rebalance each year. Next is dollar cost averaging. What is dollar cost averaging? It's adding another level of protection. So here are the levels of protection right now. You have your asset classes. We said don't put all your money in Canada or the US, invest right across different asset classes. Then use the index, right? So don't just buy one stock, buy different stocks. And then don't invest all in one time, invest over time. So we're going to do a little bit of a quiz here. Suppose you're investing $1,000 a year in a fund for 5 years. Which of these two funds do you think would perform better? I'm going to show you two. Here we go. Here's fund number 1. And here's fund number 2. Okay? Those are them together. Put in your answer in the comments section. This isn't a trick question if you're thinking like, it obviously has to be fund number 2. It's just too obvious, so I'm going to pick fund number 1. I'm not trying to do any reverse psychology on you. Just pick the one that you think is the best to invest $1,000 a year into. Fund number 1 or fund number 2. So put your answers in the comment section. Fund 2, fund 2. Great job, Charlotte, Adrian, Kim, Christina. Great job, James, Isabel. Okay, most of you said fund number 2. The answer is actually fund number 1. Isn't that crazy? Fund number 1, you would have made more money. You would have made $6,700, while fund number 2, you would have only made $5,740. Even though the stock started at 100 and ended at 100. How is that possible? It's because when the markets go down, your money buys more shares. So it went from $100 to 50. You're still investing $1,000 into that stock, but your $1,000 now buys 20 shares instead of 10 shares or 9 shares. So because it's like at a discount, your $1,000 buys more. And then the next year it went up a little, your $1,000 buys more. And then now that it's gone back to $100, you have a lot more of these shares. So you're really buying low and you're buying a lot more. Let me know if that makes sense. Put in makes sense into the comment section if that makes sense. When the markets go down, it's a great opportunity for you to buy, and your money buys a lot more than it usually would. When I was last year when the pandemic hit, you had companies like, let's look at Air Canada as an example. This is risky because this was in, the transportation. But, I remember mentioning, guys, Air Canada right now is at $12. It's at $15. Now it's at $22. So your money buys a lot more than it would when it was at $50. You could see there's a great opportunity to buy. Were some other companies, even like CIBC. Look, CIBC went all the way down to $77. Now it's at $151. So you could have doubled your money because it was so cheap and your money bought a lot more. So that's what dollar cost averaging is all about. That is the essence of it. You want to invest a regular amount on a consistent basis because people always ask us, Arian, I have a lot of money. Should I invest all at once? No, invest a small amount every single month. Why is that important? Because if the markets crash, and when they do, because the markets will always crash, we just don't know when they do, you're going to continue to buy and you're going to buy at a discount. Burt Maliki said it best. He says dollar cost averaging is how you make the volatility of the market work for you. Yeah, look what Jeff said. VFV went from 79 to 59. Now it's at 100, right? And that's a really safe one. Let's take a look. Let's take a look at what happened with VFV. $78, boom, right down to 58. Guys, you know that when the markets crash, 500 of America's largest companies are going to bounce back. We are resilient as human beings. America is resilient. It is very rare something that's going to happen, even a pandemic that's going to keep us down. We're going to continue to get better and improve. And hey, if something does happen, there's going to be a lot bigger worries than money. I could promise you that. So VFB, remember, that is the ETF that tracks the 500 of Canada's largest, or excuse me, America's largest companies in Canadian dollars. All right. Go in here. I love this from Warren Buffett. Be fearful when others are greedy and greedy when others are fearful. So true. Guys, if that's true, put in true in the comment section. Take a screenshot of that one, and this quote I had to read 1,000 times in 2020. I had to wake up because, man, you wake up in 2020 and you're reading news. The stock market is a disaster. This time is different. This is a health crisis. The stock market will not recover. This is horrible. And you heard all the news of why you shouldn't invest. And to this day, there are people that sold and have not entered the stock market, and they lost out on a huge opportunity. Let's talk about emotions and discipline. Rule number 1, turn off the news. If you're getting any financial advice from YouTube or the news, you got to turn that stuff off. There's a great quote. They say you need to consume less and study more. Consume less and study more. Stop watching news articles on the stock market and start studying how the stock market actually works. Big difference. And remember, pessimism is persuasive. Guys, in 2020, these were some of the YouTube videos that I saw. Look at this one. The Road to Economic Stock Market Recovery in 2021. Great, very positive headline, 4,000 views. Not very exciting. This is CNBC. They have millions of subscribers. A message of spending stimulus suggests strong economic rebound for 2021. A very positive message, only 5,000 views. Now look at these ones. Why Grant says the next stock market crash will rival 1929 and 2000. 2.2 million views. Look at this. Harry Dent. Stocks to crash 40% by April and won't rebound for decades. Oh my gosh, 1.3 million views. By the way, he was completely wrong about that. as were all of them, but these are the videos that get views. Why? Pessimism is persuasive. In the news industry, there's this old quote that they say, if it bleeds, it leads. People don't like hearing positive news because as human beings, we have this fight or flight mentality that we always want to be careful of the danger. So we're more drawn towards things that can threaten us, like these things. And that's what we gravitate towards. There's another guy, his name is Dr. Doom. He's one of the best known market forecasters. He successfully predicted 2008 live on the news, and people respect him, and he's a market forecaster. He can predict the future. Even though he was right about 2008, here were the years that he made incorrect predictions: 2004, 2005, 2006, and 2007. But one year, you know, isn't that crazy? He was right about 2008, but he was wrong about the following 4 years. And anyone can do that. Just go on Facebook Live January 1st of each year and say, this year, based on my research, there's going to be a market crash. Guys, do that every single year, and one year you're going to be right, and people are going to be like, how did you know? Oh my God, you're a genius. You're going to be on CNBC. You're going to be on the news. You can have your own YouTube channel. You could do speaking engagements, just like this guy. It's crazy. Next is automation. You want to automate your finances. It's very important. This is what it looks like for myself. This is what your investment plan should look like. Sit down and figure out how much. Rule number one, step number one is sit down and commit. Commit a dollar amount each month and treat it like a tax. This is a payment that you're making to your future, and it is a non-negotiable amount of money that you're going to invest each month. And do it. Okay? No negotiating. I don't care how it makes you feel. This is a tax that you're paying to yourself for your future. Next, decide on the ETFs that you're going to buy, rebalance, and number 4 is just a friendly reminder. So here's what it looks like for myself. Every single month I have an automatic transfer, your checking account to your investment account. In this case, it's $200 each month. You can start at $50 and just make your way up. The most important thing that you could do is start somewhere. I don't care if it's $5 a month. Just get started and let momentum work for you. And then every single month I have a reminder to go into my account, and the money gets automatically transferred into my Questrade account. I'll go in, I'll make the trades that I need to. That takes 5 minutes, and that's it. It's as easy as that, right? So really simple and really easy. So guys, I hope you enjoyed this session. I'm really excited because we're going to give you all a stock investment glossary. These are some of the most important terms to understand, not just in stock market investing, but real estate and different types of investments. It's a full glossary. Let me see if I can pull it up here. Here it is. So this is a great glossary. You're all getting this for free. There's stock market terms, property investing terms, mortgage terms, home equity terms, financial advisor terms, private equity terms. It's just a glossary. All the terms that you need to know, like capital gains, common share, earnings per share, emerging markets. And it's a great, just handy resource to have when you will come across something, you're doing your research, just come across like, what does dividend mean? Okay, here's what it means, right? And a great glossary. So who's excited to get access to this glossary? Put in excited in the comments section. This is one of the newest resources that we put together. So I'm really excited to give you all access to this for free. I'm going to give it to you at the end. This is a really cool resource here. Awesome. Sweet. Yep. So I'm going to give you the link really shortly. Before we do, I want to share about this free assessment call that we're doing. So guys, right now we're almost in November. Can you believe that? It's October 26th. The year is coming to the end. What you do now is going to determine the quality of your 2022. The foundation that you set now, the different things that you do with your money, are going to make your 2022 either a great year or an okay year. And I want to challenge all of you. Let's set ourselves and our family up for an incredible 2022, and it starts today. It doesn't start January 1st, it starts now. So we want to help you jumpstart your 2022, and we're offering everyone a free assessment call. So this is a live one-on-one call with the financial freedom consultant, and during that call, we're just going to get a really good understanding of where you're at. What are your goals for 2022? What are some of the challenges that you faced in 2021, and how can you overcome those challenges? And then by the end of the call, we're going to help you create a plan forward. Create a really good plan for you and your family on the next steps that you could take to make 2022 your best financial year. Now, the challenge that we've noticed with so many Canadians is they attend classes like this. They attend online courses, even the ones that we offer at Enriched Academy, but they don't really do anything with the education, and they're not where they need to be. They've been saying they want to buy an investment property for years and nothing has happened. They said they wanted to create a financial plan, but nothing has happened. A lot of people have good intentions, but when it comes time to taking action, they fall short. And that's okay. Most of us are like that. But it's important to understand education is only the first step to transforming your financial life. And of the 200,000 students we have at Enriched Academy, the ones that really change their life for themselves, their family, and their kids are the ones that take action. They're the ones that watch videos like this and start investing. They're the ones that watched investment property videos and bought that investment property instead of wondering, instead of, getting fixated on these small decisions like, should I buy a property here? Should I buy a property there? Should I buy a duplex? All these indecisions can hold you back from taking action. So that's why we created this coaching program, is because we realize asking Canadians to do this on their own is a really big ask. And some can, but that's just a very small percentage of people. Most Canadians need guidance. They need someone to hold their hand. They need a coach. And that's why we created a coaching program. This isn't someone that's going to sell you investment fees or try and get you to buy financial products. This is someone that's going to be acting in your best interest. They're going to get a full understanding of where you're at, and they're going to help you achieve your goals. And the great part about a coach is they've been there, they've done that. They've already helped thousands of Canadians just like you, so they know exactly the steps that you need to take. Now, with Canadians, we've found there's three big challenges we face when it comes to making financial decisions. Number one, we get nervous and scared. Number two, we lack discipline and motivation. Or number three, we try to get started, but we encounter roadblocks. Maybe you want to start investing, but when you go open up your brokerage account, you can't connect your accounts right and you kind of give up and nothing happens. These three reasons really cause a lot of financial stress for Canadians. In fact, if you take a look at this, the number one cause of stress for Canadians is money. And 70% Canadians don't have a retirement plan and think they won't save enough for retirement. Really, the big problem is Canadians are not able to live the life that they desire. And a great question to ask yourself is, am I living the life that I want to? Am I in control over my money to live the life that I want to? If the answer is no, you need to make a change, because more money isn't going to solve your issues. Maybe one or two investments won't. You need to change your financial plan and the way that you're going about your money. So that's why we created this coaching program. It's really incredible because it's 6 one-on-one virtual meetings with the financial expert. The first thing that they're going to do is they're going to do a study and a survey of your financial situation and create a customized plan for you for whatever your goals are, whether it's investing, creating passive income. It's going to be 100% personalized to you and your family. And one of the most important parts about the coaching program is an accountability system to ensure you take action. Giving you information is step one. Making sure that you take action on it is step two. And we've created systems with reminders and check-ins to make sure you do just that. And the goal of the coach is to create a foundation that will pay you forever. The program usually lasts about, 1 to 2 years. And during that time, it's really a foundation for a better future for you and your family. You'll also have lifetime access to on-demand financial literacy courses and tools. Now, a big question people ask is, does this actually work? It does. If you take a look at from as of June 2020, our average coaching client increases their net worth by 50 grand. That's money back in their pocket. Credit score increased 28 points. Total advisor fee saved 1.25%. One of my favorite stats is our average client puts an extra $1,200 back into their pocket for themselves and their family. Guys, what would an extra $1,200 mean for you and your family? How much more freedom would that bring you? How many less hours do you have to work? A lot of our clients, they go from working 5 days a week to 4 days a week because they're managing their money better and smarter. Decrease credit card debt and increase passive income. Now, can you do this on your own? You absolutely can. It's just going to be a lot harder and a lot longer when you could just get a coach that will show you the way, as they've shown the way for thousands of other Canadians. So again, we've offered everyone a one-on-one assessment meeting to really get an understanding of how the program works and to help you jumpstart your financial success. Now, how this assessment call works, we're going to evaluate your financial situation, identify the root causes that are holding you back, set up goals for your better future, and help you design your path forward. Now, is this assessment meeting for you? Here's just some great questions. I want you to just answer yes or no in your mind. Do you want to be aware of your different options? Maybe you don't get a coach, but at least you're aware of that option for you and your family. Do you want to achieve your goals faster? Do you need help taking action? Like, just answer in your head yes or no. And do you feel like you should be doing better financially? Yes or no. If you answered yes to any of these questions, then try the free call. Guys, it's a free call. The best case scenario, you learn 1 or 2 ideas that could change your life. The worst case scenarios, you just did this free call, 60 minutes, right? So why not give it a shot? So there is limited availability. Guys, there is a link in the chat box. So please click the link and schedule your call. We only have 3 individuals doing the call, and the spots get filled up extremely quickly. The other thing I do want to mention is we have a 1-day event coming up on Friday. Initially, we only were able to have 50 people for that event, and the hotel just said we can have 120 people. It's very last minute. It's this Friday. The cost of the event is about $400. It's great. You're going to see us live. It's a live event. So if you are interested in attending the live event, just put in yes in the comments section, and I'll have someone reach out to you to tell you more about the event and if you're interested. So it's a full day event. We talk about things like stocks. We do a review of that. You get this great workbook. We talk about real estate investing, retirement planning. It's just a great, great live event. So awesome, Greg. We'll reach out to you, my friend. And there should be a link as well for the glossary. Okay, awesome. Thanks so much, Mark, for putting that in. And then if you could I could put the link for the glossary. There is the link for the glossary right there. Sorry about that, Jason. Sorry we didn't do a Q&A. Let me see what questions you have. We're going to do a Q&A, guys, for 15 minutes here. So if you did have any questions, please do ask them. Ask them again because they got lost in the feed. You could see how fast it goes. So please ask your questions again. I'll take 10, 15 minutes here to answer them. And again, if you did ask the questions before, just ask them again so that I can see them. Okay, I like this question from Adrian. Does it make sense to take out a loan to max out your investments? Ooh, Adrian, good question. It really depends on your situation and your risk tolerance. I personally do this. I do because the loans I'm getting are 4 to 5%, and I know I'm getting above 12, 13% return. So I'm absolutely doing this. The great thing about doing this as well, Adrian, is you can write off the interest. That interest is tax deductible. Any money that you use to invest is tax deductible. Great question. Great question, Warren. Are you saying that the account I found my stockbroker should be from a TFSA? Absolute. Okay, so Warren, you can fund your account with a checking account. Okay, but you need to make sure the investments are held inside a tax-free savings account and not a regular um, checking or savings account. Let me know if that makes sense. So you can fund your investment account with your checking or your savings account, but you have to make sure the investments are held inside of a registered account. Awesome. Chris says it works. Great. Best financial decision I made. Chris joined the coaching program. He's been a huge supporter. Chris, hope you're doing well over in Kingston. Um, he's a great realtor in Kingston. So if you are looking for an investment property, he is the man to get in touch with. Okay, Jason asks, can you explain the live event again? Yeah, Jackie. So the live event is from 9 o'clock to 5 o'clock. It is a live event where we cover all important topics on financial literacy. The day starts off with defense. So we talk about credit scores, budgeting, and then it goes into offense. That's where we go into stock investing. Like this section is going to be a part of the event, private lending, home equity line of credit. It's a great event to attend because the energy is so different when you attend like an online event like this versus being there live. There's a live, it's a workbook, and we've heard so many students say, I've attended all your webinars. It's until I attended the live event. That's what really inspired and motivated me to take action. So Jason asked, should you fund your stocks from a TFSA? So Jason, similar to the answer that I just gave to Warren, is you can fund your stocks with the TFSA. The most important thing, Jason, is to have your investments held inside of a TFSA. Let me know if that makes sense, guys. I hope that makes sense to you. Um, awesome, Adrian. Awesome, Sylvia. Mario asks, what are your top performing ETFs over the past 5 years? Great question, Mario. So, I'll give you my top three. My top three have been VFV for sure, the Canada one VCN, and I also have a Chinese ETF. Let me see if I could get the name for that one. One second, I'm just getting the name. Da, da, da. It is GXC. I'm very bullish on China, but whether or not they do well, I want to own this ETF here because this tracks some of China's largest companies. And again, this is a small percentage of my portfolio, but you can see the past 5 years had a 50% return. Again, not as good as the S&P 500, but that is there. Okay, Jason asks, how do you do that? So how do you make sure your investments are held inside of your brokerage, inside of a registered account? So Jason, the best thing to do is get in contact. If you're using Questrade, all you do is talk to Questrade and say, hey, listen, I need you to make sure my investments are held inside of a TFSA. And they'll set it up for you. It's so easy to do. It just takes some time. Every time you open up a new account with Questrade or Wealthsimple, they're going to ask you, is this a TFSA? Is this an RSP? So if you've already opened up an account, it might be hard to switch from like a checking or a margin account to a TFSA. You might need to open up a new account as a TFSA, and then when you transfer the money in there, you're good to go. Yeah, is it possible to learn about doing stocks only? Yeah, Faye. So, Enriched Academy, we only focus on the passive investing. Now, is it possible to take education and to invest in individual stocks? It is. I've taken courses. Now, these courses, to get good quality ones, are not cheap. They're not like our courses that are a couple $100s. I've spent over $15,000 on courses specifically on individual stock market investing, like to buy individual stocks and how to research them. Um, and they're nowhere as good as Enriched. That's just my bias. But anyway, and I've followed their philosophies. And even though I spent $15,000 and hundreds of hours studying and researching, my returns are still not as good as just investing in an ETF. So, Faye, the answer is yes, you can. It is just so difficult to educate yourself to buy individual stocks. Now, if you're someone that wants to do more active investing, I would recommend to look into something like Forex, futures, or options trading. Now, just understand the education for those is expensive and it is going to take you time and an investment up front. Okay, I'm going to ask last question here. What is your view on VBAL? So VBAL is a all-in-one ETF, and I'm a big fan of these. I really, really like these. So basically, this is one ETF that you can buy, and inside this ETF are different ETFs. So let's take a look at this one. So you can see it's 60% stocks, 40% bonds, very safe. You can see the number of stocks, 13,000. Number of bonds, 17,000. Very diversified. And these are the different ETFs inside of it. So you have a US ETF, a Canada ETF, another Canada ETF, a developed all cap ETF, global bond ETF. So I like these. I think they're great. It's a really simple solution where you could just buy one ETF and this takes care of your entire asset allocation. Oh yeah, Jason. Yeah, Jason, the coach is going to give you way more customized and personal help with this, and they're going to be able to go really deep with you. So, absolutely, let us know how it goes. All right, guys, last question here. What is the perspective on Wealthsimple? I like it. I recommend all my friends to use Wealthsimple because, there's different levels. If you're someone that really doesn't want to spend a lot of time, then use a Wealthsimple. They make it so easy. If you want to spend a little bit more time and have a little bit more control, then you can do like what I just showed you, like buying ETFs and things like that using Question, and your fees are going to be lower if you do it yourself. But it really depends on you. If you're like, I don't want to do all this crap, use a Wealthsimple. They charge more of a fee, but they make it really simple and easy to do. All right, thank you all so much. I hope you enjoyed this. If you could do me a favor and share this with a family member or a friend, we would appreciate it. And yeah, looking forward to having all of you at the event. And yeah, learning more about Enriched Academy. So thank you so much. Have an amazing, amazing rest of your day, and we will talk soon. Bye for now.